Hello, this is a lecture video for 6th semester student, and the course is Introduction to Financial Management. The course is Financial Management. I'll be taking the initial two units of Financial Management, that is Introduction to Financial Management. So I'm sharing this course, so other teachers must have started with other portions in their notes or lecture videos, whatever they are giving it to you. So I'm starting off today. I'll be gradually moving towards time value of money and other part of this first unit and second unit. If you have already got notes of these two portions, then see this lecture video as a tutorial. Now I'll be giving you small videos of about 10 minutes, right? So for introduction I need two videos like 10 minutes and another 5-6 minutes video. So when I start financial management, just let me tell you one thing, that I'm assuming that you are quite familiar with accounting because you have done till corporate accounting. So what basically you learn in accounting, or what you do in accounting, you produce three final statements, right? One statement is called balance sheet, another statement is called income statement, right, or what you call sometimes profit and loss account, and another final statement is called cash flow statement. So cash flow statement, right? There are many questions that these three statements can answer, right? What is your current position of the assets and liabilities? That can be answered by three statements. What is your current position of profits? That can be answered by these statements. What is the position of your cash and how your opening cash is converted into today's closing cash, how the cash actually moved throughout the year? That can be answered by cash flow statement. But there are many things. Now look into these particular three things in accounting. They are basically an output of mere recording of whatever has happened in past, right? So today's cash flow statement is actually giving an action what has happened in past. Today's balance sheet is actually giving you an action what has happened in past. Today's income statement is giving you an income for the past 1 year or the past 1 quarter. So the essential feature of an accounting, right, is that it can give many answers but based on your past actions. That is where the financial management differs from accounting. It gives you an answer based on the accounting data. Obviously we get the data from these statements, but based on these data it actually tries to look into future. So let us see some of the questions. Suppose firms always face several decision dilemma. Suppose government has invited tender for construction of the roads. How much should a construction company like Larsen and Toubro quote? So it's a problem of you can say in finance we call sort of capital budgeting, right? In finance we call it capital budgeting. So basically there is a call for contract, and I need to quote a certain amount, certain price. That means I'm actually considering my investment into that, I'm considering my profit into that, and I'm also considering that these investments and profits and cash flows, what are going to happen, all are going to happen in future. So nothing has happened today, all are going to happen in future. So essentially you can find the difference of financial management with accounting. Here everything is going to happen in future, where accounting, something has happened in past and I'm recording today. So when I quote a tender, something I'm expecting that this can be the price, this can be the returns, and I'm considering my profit, my expected profit in future. See, it is not my profit what I have already earned, this is expected profit in future, and after adding all these things, my cost and profit, I'm actually quoting my price. So that is how financial management is different, and these kind of problems we deal in the capital budgeting problem. Suppose there is another situation. Tata Motor requires money for expansion of its manufacturing facility. So it is coming out with new cars. Suppose if you consider the manufacturing facility what was coming out in Singur nearby, so there was a lot of fund invested in that. Now Tata had to think that what will be the sources of these funds. So there can be money, there can be fund that can be taken from bank, funds can be taken from public, funds can be taken as a fixed deposit from public, funds can be taken from public as by issuing the debentures, funds can be taken from public by issuing initial public offerings, funds can be taken from bank as we have already mentioned. There can be collaborations with other companies, other company can take share of my investment, so there can be a lot of things. Now essentially what basically you are considering here is everything is expected, something is going to happen in future and you have to arrange those, so that is where it is different from accounting. So finding out sources of funds, right? How do I finance a business? That's a very important and prerequisite for any financial management decisions of any corporates. This has come in the news in recent time. Bengal Chemical has got the permission to produce hydroxychloroquine in very large quantities. Now the company was producing something very naive kind of products, and hydroxychloroquine production was stopped for a long period of time. And when they have got an order, then order was for a huge quantity. They have to work in shifts, day in and day out. Now that is an operational part of it, but the other part of it, that of this particular decision, is that you have to arrange fund for this, because you need to buy raw materials, you need to employ more number of laborers, and that is not usual. Usually I do not have so much requirement of raw material, usually I do not have so much requirement of labor. Suddenly I need so many things at one time and at once. So what will be the requirement of capital? How much money do I need? How much fund it has to arrange to run the production? So that is sort of we call it a working capital decision. Working capital decision. So this is also a very important part in the financial management, working capital decision. Let us consider another example. Like suppose TCS has reported, just it has come into news this quarter, TCS has reported year end March, the last quarter TCS has reported huge profit. The profit was even more than the similar quarter in the last year, but its future is uncertain due to this COVID-19 situation. Should it declare dividend? What is a dividend? It's a share of profit. When you earn profit, then the owners of the company should get the dividend. Now you can take a decision to take the profit this year, or you can take a decision to make it reserve and surplus. I hope that these terms are familiar with you, because you are doing corporate finance, corporate accounting. So I can go for reserve and surplus, or I can distribute some amount of the profit in the form of dividend. So whether I will go for dividend or not, so this is a concept what we know as dividend decisions. Sorry, this is a concept what you know as dividend decisions. uh, Dividend decisions, right? So these are certain questions, and there are many more questions like these that a traditional accounting will not be able to give you answer. So we have to resort to certain different aspects of analyzing a finance of a company, and this particular different aspect is dealt in financial management of corporations. Now, so everything what we have actually discussed, right, in the last this Tata Motors requires money. So I'm actually basically finding out that what should be my capital structure, whether it should be owner's capital or it should be loan capital from the bank. So all these things actually primarily divided, or primary there are four divisions of or broad divisions of financial management or the corporate finance, what managers actually do. The four broad areas of the financial management. The first one is the capital budgeting. There are very sub areas in capital budgeting. The second is capital structure decision. Like Tata Motors want to raise fund, then what will be the sources of fund? What source I want? Then dividend decision. I have made profit, whether to give dividend or keep it as a reserve and surplus. Then working capital decisions. I have made profit. Then I have got a business. I have got a production to do, and how much fund do I need to arrange for that purpose? Now essentially these each and every particular concept, every particular aspect or area of finance uh, brings some amount of risk, and also it brings some amount of return. Why it is risky? Because return is inherent, because unless and until we have potential for profit, we will not go for anything. Sometimes return means savings of cost. Now risk is inherent to this because all these particular events are future looking.